Okay, hello everyone. Welcome to today's webinar. My name is Ezinne Hart, your favorite host. This is Brickhills Consulting. Welcome. We are happy to have you here. Today we'll be talking on financial fluency for the everyday leader, mastering budgeting, cash flow, and profitability. And I have no other person but my one and only finance expert. Her name is Chigozie Ukachi. I'm just going to be reading up her profile. So, yeah. So, Chigozie is a chartered chemical engineer and operations consultant with several years of experience in the aerospace, energy, and consulting industry. She, since graduating from University of Manchester, she has held roles as a design engineer, project manager, and a program manager. Most recently, she was an associate at the McKinsey, where she solved complex operations problems on a global scale, addressed digital transformation challenges, and developed a passion for consumer electronics. She's completed her MBA in Harvard Business School, and she is currently working at Apple. Welcome, Chigozie. She's going to be taking on this topic. She's going to be enriching us and engaging us in this session. So you would do well to take notes of, the areas you really don't understand and ask questions as she would, do justice to this topic. Everything finance, not everything, but like major areas in finance, mastering budgeting, cash flow, and profitability.
Amazing. I'm really excited to share this topic. So I think it's a very important topic for both finance and non-finance leaders. So let me just share my screen and we can get started. Before we get started, I don't know if it's by accident, but I do see him up. Okay, let's assume it's by accident. So this session, we're going to be covering mastering business finance, and it's going to focus on three main topics: budgeting, cash flow, and profitability. And it's geared towards both people who are know finance a bit, but more towards non-finance professionals. I think as long as we're in business, everybody needs to understand finance. So I think how we're going to structure this section, we're going to first introduce business finance overall, kind of why it's important. Then we will introduce the three topics. So we introduce budgeting, we'll introduce cash flow, we'll introduce profitability. We will then deep dive into each one of them. So kind of like, how do you do it? What are some of the tips for doing it effectively? And then we will then cover kind of more, the practical, how you do it on a day-to-day basis. So that's kind of the structure of this presentation. So again, what is business finance, right? Um, it's all about how do you manage all the financial aspects of your business? How do you make sure you are able to remain both profitable and also operate efficiently? I think there's a lot of proxy in business finance with kind of at home. So kind of how do you, in terms of like, how do you justify this, what you spend on every day, and how do you contribute meaningfully to your life? How do you contribute to the success of a business? I think we're going to be covering those topics shortly. So why is it important to know this? Finance is such a core business, whether you're in marketing, plan for your team, be able to put together a budget and be able to know my income, what are my expenses. If you know finance very well, you also be kind of justify investments. We're going to do this. If you fully understand a project, you'll be able to say, oh, my project helped me increase profitability by 20%, or my project was able to add 1 million naira to the company. So it also allows you to kind of communicate the value that you bring to an organization. So some of the key principles we'll be covering is, how just knowing how money flows in, flows through a business. So that's all about kind of budgeting, planning for budget, understanding cash. Then the second thing is understanding the difference between revenue, profit, and cash. The thing about finance is that a lot of the concept are potentially simple, but a lot of it is kind of language terminology that people use to kind of complicate, relatively simple terms. And then the other thing is being able to, read and interpret financial data. At a small level, it's like, okay, you would be able to know whether your department is profitable. At a large level, it's like, okay, think of a S&P 500 company. You should be able to read, their profits and loss statement. You'll be able to read their cash flow statement and understand what it's telling you. So now we would then start deep diving into the three main topics. The first one is budgeting, as I mentioned. The second one is cash flow. And then the third one is profitability. So we're starting with budgeting now. And want to start with what is the importance of budgeting? So a budget, what is a budget? A budget is just a plan, a financial plan. Like how do you allocate your resources efficiently? In business, a good proxy for business is always the home life. In your home, you probably know how much income you're making in a month. You probably know how you're going to allocate it. Okay, say you make, 2 million naira in a month. You're like, okay, this month I'm going to allocate 500,000 to, rent, to paying bills, or I'm going to allocate 100K to shopping. So it's kind of like, how do you make a plan for where your money comes in and how you're going to spend the money? So in a business is what is the revenue I'm going to make, which is what am I going to sell this month? Let's call it for a month. What am I going to sell this month? Let's say you sell something for like 2 million, and then it's like, okay, how is it going to be spent? Okay, I need to pay my staff salary. I need to pay rent. So being able to make a financial plan is just being able to step back and make sure you're able to allocate your resources well. Why is it important? It means if you're able to do this proactively, a budget is a proactive thing. You're able to control cost. So if you've already said, okay, I'm going to allocate, 1 million naira to paying my salary, the salary of my staff, you know that you've allocated that money. You're not going to go spend it on something else. So it prevents overspending. The other thing it does is it aligns like development plans with organizational goals, because when each department, so the operations department will put their own budget together, they will list what the budget is for, and then maybe the marketing team will list their budget plan, what it's for. And when you bring it together, you're able to analyze it to say, okay, is this going to overall help us with our strategic goals? It's going to increase our revenue in the areas we want to increase our revenue. And then a very well prepared budget allows you to measure like performance, comparing like actual versus forecast. So say, for example, you budgeted somehow 1 million to naira to pay your staff. All of a sudden, somehow you pay them 2 million. You're like, why am I paying 2 million? Did I hire more staff than I predicted? Or did I spend more per staff than I had predicted? So it kind of helps you measure actual versus forecast and be able to problem solve issues. So it's a very important foundation in a business. And I would also say in your personal life as well. So in business, there are three types of budgets. One is operating budget, the second is capital budget, and the third is cash budget. Operating budget is a lot of the examples I'm giving. It's kind of like your day-to-day budget. So in a business, you get your revenue. My revenue is 2 million naira. Your day-to-day expenses, I need to pay my staff, I need to pay my rent, I need to pay my bills. So that's kind of operating budget. It's kind of like uh, running a business, the day-to-day factory, more for one-time investments. So in a business context, let's say you want to open a new factory. You manufacture Coca-Cola, for example, and you need to open a new factory. So you budget the money in advance and say, okay, I'm dedicating that to this one-time big expense. In your life, it could be, you want to buy a house. And so you're budgeting money for that one-time capital expense. And then the third is cash budget, and it focuses on inflow and outflow. So it's kind of like, okay, today I'm selling Coke, I'm going to sell 100 Coke. is going to give me X amount to pay my supplier immediately. So that money also maybe disappears completely, have profit to your and have money for your business. So it's kind of like looking at when does cash come in and when does cash go out. So those are things. Now we've talked about budgeting, which is like an introduction to budget, which is the second aspect. You hear this a lot. Understanding cash flow is probably one of the most important things you could do in a business. You hear some of this in the past, potentially, where you say cash is king. Cash is truly king, actual cash in and out of the business. So a positive cash flow tells you great than is going out. So if 2 million is coming in and 1 million is going out, wonderful. You have positive 1 million. Great. Your million coming in and then you have 3 million going out. That's negative. Say cash is king. If you don't have cash, you can't almost do anything in business. Pretty much go bankrupt because you can't pay your staff, you can't pay your suppliers, and so you pretty much go out of business. So that's why understanding cash flow is such an important concept. Just look at it. You have to pay salaries, pay rent, pay suppliers. Without cash, you just cannot do it. And something that's interesting is you can have a profitable business and still run out of cash. The reason is that, profitability, the way we have allowed ourselves as and as kind of, I guess, as businesses, or the principle we run on in terms of recording profitability is that you can record something as a revenue when you actually have not received cash. And so, which means that sometimes you can actually, which is why people have to always look at their profitability and also cash, because you can say, okay, I have already, let's say it's like Coca-Cola. My customers already placed this order, and maybe I've already shipped the order to the customer, but the customer actually has not paid you because you have a payment term. You told the customer, you can pay me in 30 days time. But the thing is, because you've already sold it, the accounting principle says you can record it as revenue. But the thing is, you actually have not had the cash in hand. So that's why sometimes you can see a profitable business because, accounting principles tells you can record profitability, but you may not necessarily have the cash in hand. So it's very important to not just know whether you're profitable, but also to check if you actually have cash in hand. And the cash flow statement, which is one of the three important statements that businesses have, allows you to now track the timing and the sources of cash to help you avoid liquidity issues. Liquidity just means not having cash at hand to pay your obligations, whether it's salary, rent, suppliers. So that's when they say a company has liquidity issues. So there are three main components of cash flow. And if you open an S&P 500 kind of financial statement, you will see these three main areas as part of their cash flow statement. One is operating activities, the second is investing activities, and the third is financing activities. Operating activities is pretty much your day-to-day things, which I think we've talked about a lot. And that's like, okay, the revenue you get from selling, let's call it Coca-Cola, selling bottles of Coca-Cola, the cost, and so that's the cash you get from that. And then your day-to-day expenses, which is paying salary and all of that. So that's operating activities because it's just what is core to operating your business. The second one is investing activities, and we talked a little bit about it as well. This is about what's the cash you're using to purchase assets. So what's the inflow of cash? What cash are you using to either purchase or sell an asset? So if you are, maybe purchasing a building for a factory, you're purchasing it for 2 million. So that's 2 million of cash going out of your company. Or maybe you already had this factory for a long time and now you're selling it and you're able to sell it for 1 million. That's 1 million of cash coming into your business. So this is The investing activities is all about the cash that you get from the purchases or selling of assets. And then the third is financing activities. These are cash you get from your bank, for example, loans and equity. So, you want to run your business, you go to a bank and say, hey, I want 1 million naira, and they're able to give you 1 million naira in cash. So that's cash from financing activity. You can also get it from equity, which is like, you have investors and they're like, okay, an investor tells you, yes, I can give you 1 million to support you in your business. So these are kind of like financing activities. So these are the three main components of cash flow: operating activities, investing activities, and financing activities. Now we're moving to the third key concept, profitability. We briefly mentioned it's like profitability is not cash. It does not equal cash. We mentioned that in the past. Profitability just is a way a company tells, how much is it earning and how much is it spending. And so, and this allows you to know whether a business is efficient and sustainable in the long term. So the three types of profit, similarly, if you go to an S&P 500 financial statement, you always see what they call a P&L, which is a profit and loss statement. And within that, you tend to see three types of profits. This is the three types of profits any business should record. It's your gross profit, which is really more the core. It's looking at revenue minus cost of goods sold. So in maybe a company that is manufacturing, we've been using Coca-Cola example, like a Coca-Cola, the revenue comes from selling a bottle of Cokes. The cost of goods sold comes from the raw materials, kind of acquiring the bottle, acquiring the concentrate that goes into the bottle. It has to do with both the raw material, it has to do with the labor that you're using to produce the Coke. So that's like your core, and that's like gross profit. So once you've checked your gross profit, which is revenue minus cost of goods sold, you then go to your operating profit. Your operating profit then goes from gross profit. It tries to take away all the other additional expenses, your sales and marketing that you need to do. So general administration expenses. So whilst gross profit, focuses on, your, cost of goods sold, which is your expenses that's related to manufacturing the goods, operating profit also takes into account other expenses that are not directly related to manufacturing the goods. So like I mentioned, sales, marketing, all of that. And then you go to net profit. Net profit takes into account any additional things. So it can be taxes, it can be interest that you need to pay as a loan. So net profit is kind of the final profitability aspect that you look at. People look at all three because it depends on what you're trying to sense from your business. The first one on gross profits, you always look at that because you want to make sure that you know how to manufacture your goods in a profitable way, which is great. Because if you don't have your gross profit sorted, you might as well forget about the rest of the other profits. So that's why you have to break it down first. And then when you go to operating profits, you're like, okay, all these other supporting activities to manufacture my goods, am I really spending the money wisely? Am I spending enough on marketing? Am I spending enough on my sales team to make sure that I'm gaining more revenue? And on the rest is like taxes and interest. So you want to make sure that you have enough to cover, the interest you need to pay to the bank. So these are the kind of the three main types of profitability. So we've covered like an introduction towards the kind of budgeting. We've covered an introduction towards cash flow, and we've covered profitability. The next few sections are all about just going into each one of them in a little bit more detail. So we'll start with the budgeting process. How do we typically do this? Budgeting, as we've mentioned, it's just about planning well. And so we've highlighted kind of the step-by-step process to planning a budget. So the first one is, you always need to know what you're trying to achieve when you have to set an objective. What do I want to do this year? What do I want to achieve this year? It's like, okay, I want to grow sales, or I want to reduce cost, because then you can allocate your expenses, you can allocate your budget to help drive your objective. So that's kind of how it is. It's kind of like if you have a budget at home, you're like, okay, I want to make sure I pay my bills, or I want to make sure that I have enough for shopping. Like that's kind of like setting your objectives at home. In business, it's like, okay, how do I want to grow sales and reduce cost? Then you need to estimate your revenue, right? It's looking at what is the money that's going, how much do you expect to come into the business? Um, or if you do a proxy to your normal life, it's like, okay, how much income am I going to get? So that's the second step, estimating your revenue. The third is, then your expenses, which is kind of your fixed and variable cost. Your fixed cost and all those things that just do not change with production. Doesn't matter how many Coca-Cola bottles you produce, your rent is going to stay the same. In some cases, your salary for things like your salesperson, your marketing team, is just going to stay the same. Your insurance will stay the same. So these are fixed costs. They are costs that just do not change with how much you produce. Then you have your variable cost. These are the ones that do change with how much you produce. So if I need to produce more bottles of Coke, it means I'm definitely going to need more bottles, which is your raw material. I'm going to need more concentrate. So that's your raw materials. The more I ship, the more my shipping cost is. So the more bottles I ship, the more I inquire shipping costs. And depending on if you have commissions as well, the more products you ship, the more commissions you have to pay. So your variable costs are really your cost that changes with your production. So now the fourth step is you allocate the funds, right? You've set your objective, you know how much money you're going to make, your revenue, you know your cost. Now you need to like allocate them to different departments. Some different departments would drive some of this, some of these revenue, some of this cost. So for example, the operations department will probably drive a lot of the variable cost, and also some of the revenue generated as well. So you kind of allocate the funds to different departments, you allocate the fund to different projects, based on priorities. We talked about also having capital budgets. So maybe you want to purchase a factory, you would allocate your funds to that. Number five here is you have to build in flexibility. I think, as we all know, in everything in life, is that nothing ever goes according to plan. And so building flexibility is a very important thing. You want to budget for any unexpected changes. A lot of businesses may have like a rule of thumb, which is like, okay, we need to add 10% on any initial forecast that we've done. So it's kind of like contingency planning. So make sure you build in flexibility. And then once you've done that and you've set your budget, which is great, the next thing is you have to then monitor and adjust. Regularly, you need to compare, okay, am I actually spending versus what I budgeted? I said I was going to spend 1 million building this factory and buying all the equipment and everything. Am I spending 1 million? Or instead, am I spending 2 million? And then if you're seeing that, and you want to do it proactively. So maybe you said you're going to spend 1 million, but you see that you're actually your costs are rising very, very quickly. And you see that there's a risk that you won't meet your budget. It means it's time for you to adjust before, let's say you're like, okay, now I'm going to reduce the number of equipments I need because this equipment is not critical, it's not that, and that is not critical. So you can kind of adjust to make sure you meet your budget. Or sometimes you take a step back and you're just like, actually, I do want these machines are critical and I just did not plan well. And so I'm okay exceeding my budget, but then you learn from it in the future and make sure that you plan better next time. And so here's a kind of like an example below, like, okay, marketing team, you received 2 million in your first quarter. You're able to divide it into different things. You divide it in 1 million for digital ads, 500K for an event, another 500K for content. And say something happens like I said, things always happen, unexpected things. Say the event gets canceled. Great, you now have 500K. It's kind of like, what's the next priority that I can relocate it to? So as you can see, what budgeting about is really planning in advance and knowing, where are you going to get money from and how are you going to spend money. Some of the kind of typical challenges that you have, and kind of how to avoid them. One is like overestimating revenue. This is very common in businesses, right? And with sales team as well. Sometimes you get excited and you just like project, oh yeah, definitely we're definitely going to earn like 5 million this year. That guy has promised me definitely we're earning it this year. So you kind of need to Be very cautious. In small businesses, it tends to be okay, not as the impact may not be as high. But say you are a global company that you have to report your revenue to the market, then it becomes an issue if you overestimated or underestimated your revenue. Either is an issue, overestimating. So you want to use conservative projections. You want to say, what would happen if this does not come in? What are the likelihood that this will come in? Um, and you kind of want to use be conservative and get multiple sources for estimating revenue. Then the second like common challenge is underestimating expenses. Um, I mean, we all costs just add up quickly. I mean, think about it in your normal life too. Sometimes you're like, oh, I want to go shopping and I promise I'm only going to spend 500, 50K. Then you come back, you've already spent 200K. Like it's cost can easily kind of go up. Underestimating expenses is a common thing. So you need to be careful that you're thinking through all the different type of costs that could come up. Let's say you're like, okay, I'm going to go to the market. I'm only going to spend 50K, but you didn't plan for the transportation there. You didn't plan that maybe there are other items you wanted to get when you get there. So it's kind of like in a business context as well, it's like, oh yeah, we're going to build this factory for 1 million, but you didn't realize that the contractor fees are higher than you thought. So, there are just things that can increase expenses. The other thing is like lack of buy-in from the team. A business is not an individual sport. It's very much a team sport. And if you put together a budget in isolation and you then say, okay, you're there as an executive, okay, I'm going to allocate 1 million to the marketing team, 1 million to the operations team. And you go and tell them and like say, this is your budget. It's very easy for them to push back. The operations team is like, what do you mean is 1 million? Have you not seen all the things we need to do? Don't you see how many staff we employ? We employ 100,000 staff, whatever. Like, how are we going to pay them with one? Like, so, which is why it's important that the people who are department heads in those areas are able to be part of the planning process. Because the more you involve people, the easier it is for them to like accept buying. So this is a common thing. People, the executive puts a budget from above and expect their team to just deliver it. Involve your teams and it will make the process easier. And then the last piece that a common challenge is no monitoring. People think they just set the budget once and forget it. But the thing is, if you do that, that's when you run to overruns on budget. And that's when you miss the opportunity to proactively correct. One, you miss the opportunity to proactively correct. And two, you miss the opportunity to reflect so that you can do things better next time. And so, do not do this. Yeah, we've done our budget, we're done. It's more like schedule regular monthly reviews so you make sure that you're keeping on top of your budget and you don't kind of overspend. So those are some of the common like challenges that businesses face. And then now more deep dive into the cash flow. So we've deep dived a bit more into budgeting. So we're just going to deep dive a bit more into kind of cash flow management. I mentioned before, and I will keep mentioning it, cash is king. Cash is just not, it's not just one of these finance concepts that is like, oh, let me just know it's cash flow, cash flow. You need cash to survive any business. If you don't have cash, you're out of business. It's as simple as. And so what does positive cash flow means? It means that you're collecting payments faster than you're spending. What does that look like? It looks like, okay, I have, 100,000 Coca-Cola bottles. If I sell it to the customer and I maybe sell it for 10 naira each or something, I get 1 million. Great, I'm collecting the cash um, upfront. And then it means that what can I do with the cash? I can pay my suppliers. I can pay my employees. Even better, let's say you have what you call a payment term. You agree with your supplier that I'm going to pay you, I'm going to pay you your money 30 days after I've acquired all the raw material. It means that you may be able to use your cash to invest in other things before you're able to pay your supplier. So it's important to know when you collect cash and when you have to pay your expenses. And positive cash flow also means, you're able to then pay your suppliers and employees on time. And it means like because you're able to collect positive cash, you can confidently invest in the growth of the business, whether it's buying new assets, new machines to help produce your product faster. It means like having cash means you can invest in the business. It's more innovation. Negative cash flow, we never want to be here. Like I said, you're out of business if you start going negative cash flow. The only times where sometimes you can be negative cash flow is that you're maybe an early stage startup and the investors believe in your business. And so you can go back to an investor to keep asking for cash, but that's just not a sustainable strategy. You want to make sure you have in a mature business, you just cannot have this type of negative cash flow where you're missing salary payments, supplier delays, losing business opportunities. And so you want to be careful for negative cash flow. Cash is king. The moment you don't have cash is the moment you are out of business. So an example here is like, okay, a company offers customers 60 days credit terms, but pays supplier within 30 days. Like this is not great. Um, it's not great because what you're saying is, I'm going to collect cash from my customer in 60 days, but I need to pay my suppliers in 30 days. So where are you going to get the cash from to pay your suppliers when you're only collecting your money from your customers in 60 days? So on the profit statement, you will look profitable because you've already shipped your product and you counted it as revenue. Look at me, I've generated revenue. But the problem is you actually have not collected cash from your customer. And so you will run into cash problems because the money that is going out to your suppliers is going out faster than the money that is coming in from your customers. So be aware of what you agree to do with your customers and what you agree to do with your suppliers. And so now some tips to improve cash flow. Um, as much as possible, you want to negotiate longer payment terms with vendor. What that means is if your customer is negotiating 60 days with you, fine. And you want to agree, just make sure you negotiate with your suppliers 90 days so that the money still comes and gives you time to like also, pay your suppliers. The example we just saw is if you're having 30 days, you don't have any money to pay your suppliers, your vendors. The other thing is you want to invoice your client quickly. If you can negotiate well with your clients and they say, oh, I want it in 60 days. If there are ways you can negotiate, no, actually, I want it in 30 days, then the more you get cash in quickly, the better you are to like pay all the bills that you need to pay, whether it's salary, whether it's suppliers. And if your customer is or your client is having any late payments, you want to be sharp. You want to follow up with that very quickly, so that you can get your cash as quickly as possible. The third thing is you want to avoid tying up too much cash in unused inventory. So what does that mean? It's like, you know, it's like overthink. Let's say you thought you're going to sell 2 million bottles of Coke, but you didn't plan well because what you're actually going to sell is only 1 million bottles. So now you have 1 million in inventory. That's cash that you tied up. You had to use cash to buy those inventory, but instead they are sitting in your warehouse. They are not being sold. So inventory planning is a very important thing. Like, okay, what realistically are we going to sell? And that helps you kind of avoid tying up cash in inventory that is not going to get sold quickly. And then the final one is just control any kind of discretionary spending. Does your business really need to spend that? Sometimes, it could be you could more focus on doing your best to improve your manufacturing line versus, oh yeah, I think we should just add a new machine. Or I need so be really careful about discretionary spending, maybe overspending on traveling or spending on other areas of your business. Sometimes they're needed, which is important, but you need to just be careful that you're not kind of overdoing it and control any discretionary spending. And so we've talked a bit more deeper into budgets, deeper into cash flow. So this is kind of just sharing how, just kind of stating how budgeting, cash flow, and profitability are linked together. These are very much interconnected, very much important for business. This is not, you don't have to be a finance person to do this. You can be an ops person, you can be a marketing person. These are just important concepts. So you can be a salesperson, important concepts to know. As we discussed, like a budget tells you how do you plan to use your money? It's all about planning in advance, your income, the revenue you're generating, your expenses. Your cash flow tells you, when you get cash in the business, how your money moves in and out, when is cash coming in, when is cash going out. And your profitability tells you, okay, am I going to have enough revenue to cover my expenses? Am I generating enough income to cover my expenses? So these are very, important concepts that anyone in business should understand. And just an example here, it's quite easy to, stay on budget, be profitable, and still go out of business. Because as we mentioned, cash is king. So this example here is like a company stays within a 10 million naira budget, but it delays billing the client, so it hasn't received any cash from your client. Of course, your cash flow suffers because money is not coming in. And so on paper, you're profitable because you're like, oh yeah, I've made money, but you don't have cash. It means you can't pay your rent on time, you can't pay your salaries on time. So which is why like discipline is so important, which involves tracking and monitoring. You just need all three. You need budget discipline, you need to make sure you have steady cash flow, and you have to have very healthy profit margins to be able to build a sustainable business. So the next few minutes, we'll just talk about some of the kind of practical, a bit more practical kind of aspects of looking at these three aspects of budgeting, cash flow, um, and profitability. Forecasting is a huge one. Forecasting is just all about, planning in advance and really trying to predict things a bit more. So it involves predicting your financial outcomes, talks about predicting your budget, and sometimes it's typically based on historical data and current trends. I mean, some people, look at the past 6 months, historical data, maybe look at the past year. It really depends on your company. And then you also want to marry it, the past is not always reflective of the future. So you want to marry your data from the past with, what does today's trend look like? Should I adjust it based on today's trend? And that supports like better budget planning and better decision making. Um, Forecasts are also used to prepare for potential risk and opportunities, and they kind of improve your ability to adjust your budgets and strategy. So it's just forecasting. It's never an easy thing to do in any business because no one can truly know the future, but you want to do it as best as you can. And you want to have agility to review your forecast and see when things need change. So effective forecasting and financial planning just ensures that, you have the right resources to meet your business goal. So you know when your money is coming in, your revenue, you know that you have enough staff available and you can pay them to be able to meet your business goals. So the tools for forecasting and financial planning tends to be about, trend analysis, break-even analysis, scenario planning are kind of like three ones. So in terms of like trend analysis, financial ratios are typically used to kind of help with some of these things and help with decision making. They help kind of simplify complex data and help you get insights. So these are kind of like, what do you measure to make sure you're looking at the right things when it comes to, cash, when it comes to profitability. So some common ratios are, one is liquidity ratio. Liquidity is just how easily do you have cash? So let's say in your bank you have 1 million naira. Great. If you need to pay your bills, you just take it and you pay your bills. Sometimes you can have assets. Let's say you have inventory that you can easily just sell and get 1 million. Great. You're quite liquid. But the problem is you're not liquid if you have like a building and you say, oh, I want to sell it, but it's going to take you 1 year to sell it. That's not liquid because you can't quickly convert it to cash. So liquidity ratio looks at, can you pay your short-term bill? Can you have enough cash to pay your short-term bill? So typically you look at like you pile all your cash and current assets and you subtract it. One is called like, and you subtract it versus all your current bills, your liabilities that you have. That's the liquidity ratio. Profitability ratio is all about like, are we making profits from our sales? So you see things like profit margin, which is like profits divided by sales. And that's how businesses tend to be able to say, okay, if I have positive profit margin, great. You can also benchmark versus competitors. If I have 10% profit margin, and you look at your competitors and they're all like 30%, then for you, it's like a hint to say, okay, is there more we can improve in our businesses? Maybe we're spending too much in our expenses, or maybe we're not just generating enough revenue. So that kind of is a profitability ratio. Efficiency ratio is around like how well are we using our resources, are you using your assets? So some type of equations you have in efficiency ratio are things like revenue divided by assets. So it's looking at, how much am I using my assets to convert to revenue? So the higher this number, the better. So, you're looking at dividing it by kind of, okay, my asset value is like 1 million, my revenue is 2 million. Okay, great. I use 1 million of assets to convert that to 2 million of sales. Great. And then the last one is kind of like here of common ratios like return on investment, which is like, okay, am my investment paying off? Am I generating enough return, like profits versus the cost that I'm putting in? So I think these are sort of like 4 common ratios. The other analysis that you typically do on a day-to-day basis is this break-even analysis. The break-even point is just saying, it's a point where your total revenue equals your total cost. It means you're not making any profits, you're not making any loss. The other way businesses talk about it is, how many, units, how many products do I have to sell to cover my fixed cost, to cover my rent, um, to cover, whatever factory cost that you have. So that's kind of the break even. So this formula is like, okay, fixed cost divided by pretty much profits per unit is divided by selling price minus variable cost. So an example here is like, okay, your fixed cost is 1 million naira, and you're selling the product for 500, and each of the product costs 300. It means that you're able to make 200 profits per product. And so the break even is like, okay, you now have to sell 5,000 units to make sure that you can cover all your fixed costs. You're not making anything extra. So if you can sell more than 500, it's perfect, because the rest is now your money that you can actually, take to reinvest in the business, because you've now covered all your cost. So this is a very important concept. And so it helps people, teams understand how much do you need to sell before you become profitable, and whether you need to, you need price reductions, whether sometimes, you need to understand whether you should do some price reduction, or whether you need anything. If you're increasing your cost, is it sustainable over time? Because now you need to sell more units to cover your fixed cost. So this is a very important kind of analysis, which just tells you how many products do I need to sell, before becoming profitable. And I think we're kind of now kind of wrapping up. Like, I've kind of introduced these financial concepts, cash flow, first of all, budgeting, then cash flow, then profitability. But you have to understand, like, finance is just not about the numbers. Finance is a means to an end. It's all about telling like a clear story that allows you to make decisions. So, which is why this is important for non-finance professionals, because you need to be able to explain this concept to your colleagues, to stakeholders, to clients. So it's more about the message behind the numbers. If you see that your costs, your increase in costs, like, okay, my costs are rising. Is this a good thing? Is it a bad thing? What is the message I'm saying here? The message to your stakeholder is like, oh, hang on a minute. We need to do something different. The costs are rising. It looks like we are um, somehow, the rent that we thought we are going to pay is increasing. Well, the message is revenue is stable. This is good for now, but maybe we need to think about growing our revenue. Maybe we need to think about an expansion strategy. We used to focus in Lagos. Now we need to focus in Abuja as well. There's always a message behind the numbers. And you want to use like charts, tables, things that are visual to help, like, in any function, we tend to use a lot of jargon. I think jargon is just a human way of trying to make us look impressive for very simple terms. It's like, oh, what is the budget variance? It's just like, how much did we spend more versus less than planned? So, and being able to understand the complex financial terms and changing it into plain, easy language will allow you to communicate kind of financial information effectively. I think so. That's it. I've kind of wrapped up the three main areas, which was budgeting, cash flow, and profitability. We talked about them. We talked about how to do them. We talked about some of the key ratios, financial ratios that we use to assess them. And we talked about kind of communicating these financial concepts effectively. So I think I will pause there and yeah, let me know if anyone has any questions.
Thank you very much, Chigozie. We'll be taking questions now. So if you have any questions, just indicate by raising up your hands, or you can send a message in the message area. We'll be taking questions. Do you have any questions on the subject matter?
Okay, I think I see one in the messages. What advice would you give new founders who feel budgeting is too restrictive for a creative or innovative startup? I think um, you're saying it's too restrictive. I think it depends because at the end of the day, you pull together the budget yourself. So the question then becomes, why do you feel it's too restrictive? Um, because you pull the budget yourself. So pulling the budget is tends to be based on what do you think you can get as an income, and what do you think, and what are your expenses? So you can make your budget as restrictive as you need it to be, or as flexible as you need it to be. When you're a founder, you have maybe a little bit more ability to get cash and get income, maybe from your investors, to increase flexibility in your budget. But I think you also have to be careful about overspending. Um, you have to be careful about overspending. You can't get it from your investors, get some, which increase your income. But the more income we get, the more risk of kind of spending, of increasing your expenses as well. So I think each founder has to take ownership of the budget, and maybe rephrase it from being restrictive. Reframe it as like, how do I use it to achieve my objective? And if it's not helping you achieve your objective, you have to then think about what can I increase? Is it my revenue, or what can I decrease to allow it to achieve my objective? So your budget should really be get to whatever objective that you have, even as a founder. Um, let's see.
So we have another question from Osato. What's your take on the 50/30/20 rule? Do you recommend it for cash budgeting?
Um, let's see. If the 50/30 rule, I need to understand in what context, because I think I've heard 50/30 rule more related to personal expenses versus business expenses. So I'm not sure if that's what you meant. So
Okay,
if
so
you can
maybe he should
clarify, great.
explain.
Yeah.
Mm, okay, so please, Osato, could you explain your question better? And then we have Obina here. He says ROI is investing in which your money works for you, returns. So in a developing nation like Nigeria, where rates and FX stability is never stagnant, sometimes you invest a reasonable sum expecting the returns at which you signed on. So my question, do you believe banks are a wise investment region?
Mhm. All right.
Or do you need him to like explain himself?
Yeah, if the more you can kind of like share kind of what you mean, because do you believe banks are a wise investment region? Is it like, do you mean investing in banks? Like in what aspect do you mean? Because when we looked at a lot of ROIs, I guess we're talking about like investing, maybe potentially like building a factory and making sure like it helps you increase your revenue, and it helps you when you look at the profit that you get per your investment, it's better. But he said, let me just read the question in development in Nigeria. Yeah, because and you're talking about FX as well. So it's kind of like, where are you investing? Are you investing in Nigeria or are you investing outside of Nigeria? I think that is a different complex when you're investing outside. Then you have to consider like foreign exchange challenges. Um, and so you need to know that, okay, a lot of this then becomes like scenario planning, which is like at your worst case, um, if, based on historical data and actually where your FX rate goes, what is your potential ROI? And what is your base case, which is like, okay, if it stays maybe relatively stable, and versus what's your best case. And so you have to look at that range of, different cases, whether it's base, whether it's your worst case, and then decide whether it's worth investing, is what I would say. Um,
Okay. So we have what do you think is more important, tracking every single expense or just focusing on big spending categories?
um, the answer for this is always it depends. So if you're a small business, you likely would probably go into a bit more detail than maybe if you're a large business. Um, a larger business will tend to just focus on the big items because you're limited in resources, and then you don't want to be, you know, the 80/20 rule. You don't want to focus your effort on things that don't really move the needle. If you're a smaller business, then the detail will matter maybe a bit more. So maybe that, your expenses are spread evenly across different areas. And so you need to maybe understand the details a bit more. So I'd say a lot of times like the how large your business is may drive how granular you choose to go. And sometimes it can also be a personal choice. Some people just want to know the detail. But a more practical thing may be like more 80/20, focus on the items that really drive the largest expense. That's my natural bias, even in life. I focus on the big ticket items because our resources and times are tricky, but it's also a personal preference as well.
Interesting. Okay, so we have from Linda, what indicators in a cash budget should I watch closely to avoid running into cash flow problem in our present economy?
Um, the the liquidity ratio, like in cash, it's always looking at, do you have enough cash to pay? Um, so what does that look like? It's kind of like, when is your cash coming in? When are you okay, my cash is coming in 30 days time, but I need to pay my supplier in 15 days. Where are you going to get the money from? So it's looking at your cash, the timing of when your cash comes in. So I think the indicator is what they call looking at your current assets, your cash minus your current liability, who you need to pay. And then you need to also look at the timing. When is it coming? And when is the cash going to leave my account?
Okay. So we have, does changing the selling price of a product affect the break-even point and why?
Yes, it does. Um, because if you remember maybe our example, the break-even point is looking at kind of the fixed cost divided by selling price minus cost price. And so if you change your selling price, you now need more, it means your profit shrinks. It means like to cover all your fixed costs, you now need to sell more units to cover all your fixed cost. So improving your selling price, great, because now you have more profit, and so you need less units to cover your fixed cost. So yeah, changing your selling price is a very important thing. Be very careful when you give discounts. Um, you need to know whether, can you still cover your costs? So yes, is changing your selling price definitely affects it because profit is selling price minus cost. And if your profit shrinks, it means that you need more to sell more units to cover your fixed cost. That helps.
Yeah. Okay, so we have how does the financial fluency needed by an everyday leader differ from that of a dedicated finance professional or a C-suite executive?
Okay, I think for everyday leader is the fluency of being able to communicate the concepts um, and communicate your value to the business. So it's like, oh, I worked on this project. And you can easily say, because I worked on this project, I was able to reduce cost for the business by 1 million, which has increased our profitability. So now you can communicate the value that you're adding to the business because fundamentally, one of the purpose of business is to make money. It's not all the purpose. I still think every business should have a social good, but one of the purpose of a business is to make money. And so now an everyday leader can communicate their value of their time and effort to executives. For a dedicated finance professional, it's a bit deeper. Now you have to really understand all the accounting principles. There are so many accounting principles you need to know when you communicate finance, not to investors, when you communicate finance publicly. So I was mentioning things like you can record revenue without actually getting any money. It's an accounting principle that allows you to record revenue without even having cash. So nobody has paid you anything, but you're allowed to record it in your profit and loss statement. Um, it's understanding. It's finance have to. They have to finance. The finance professional have to understand all the rules of accounting versus maybe your everyday leader just needs to know how to communicate their value with finance language.
Okay, so we have what are some common financial blind spots you've observed in everyday leaders, and how does this course aim to address them?
Yeah, so some financial blind spots is one is that people don't understand how important cash is. Um, a lot of people only look at profitability. Profitability, as I mentioned, does not equal cash. If you don't have cash in your account, so people just spend, 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 and then they say, "Look, we're generating revenue," but you're understanding when cash actually comes in. It's something that some everyday leaders, especially people in sales, may be blinded to because they're like, look, we've already sold this. But you're like, okay, but what term did you agree with your customer? Oh, yeah, yeah, yeah. I said they can pay in 90 days. But it's like, hang on a minute, but we need to pay our staff in 30 days' time. So I think people do not fully have like cash as a key concept. Um, I think the second in terms of finance. So people will communicate things like, oh yeah, I completed this project. Great. So what was the impact of this thing you completed? Um, is it aligned to the business goals? It's like, so it means like you have wasted effort. So let's say you completed a project, the project really does nothing for the business, but you were busy doing it and maybe you spent a whole year on it. And then they ask you, okay, what did it do? It's like, okay, I think it helped improve how we do things. And but then you have not quantified it. You can't say, yes, it decreased cost by 10%. You can't say it increased revenue by X%. You can't say increased cash. So I think people do not communicate. Everyday leaders need to be able to communicate their value in financial terms.
Okay, so we have how can small business owners or freelancers effectively use trend analysis and financial ratios like the liquidity or equilibrium ratio to anticipate cash flow challenges before they become a crisis, especially in industries with delayed payments or seasonal income?
Yeah, I think yeah, that's a good question. It's always about how can you track and monitor. The ideal concrete thing you want to do in your business is like have a dashboard that, helps you see these financial ratios. Uh, people use, I don't know if it's called, people use dashboard like, Power BI, Tableau, or even Excel. like an Excel dashboard. And then you can calculate, you can use some of the ratios. So for liquidity, you can calculate, there's one called the current ratio, which is a current asset minus current liability. So once you get all your information together, you can see it, and then you can look at it on one is like having a visual aid to be able to see it. And then the second is having regular review sessions. Okay, now it's a monthly review, it's in the calendar. I have all the right people that contribute to these metrics together, and we can talk about it. So for small business owners, like it's important to track. And I think for small business owners, Excel is probably the best avenue. You don't want to spend too much yet on tools. To do a nice simple Excel that you can use to track these ratios frequently.
Yeah. Okay, so we have another question. What part of your cash budget do you find the hardest to maintain, and how do you stay on top of it?
Um, I think in cash budgets, it tends to be delayed payment, um, especially for small business. That can be very hard to stay on top of, even both in a business or even personal life. So you want to make sure that you're tracking the time that your customer is meant to pay you versus whether they've actually paid you and have they paid you in full. Um, so if I bring it to a normal, maybe to an everyday context, um, you're renting, you have an apartment or a house, you're renting it out. You need to know when you told them you have to pay me the first of every month. If you don't monitor, if you don't track it, and they pay you maybe on the 30th of the month, but you wanted to use that money that was coming in as rent, then you're kind of in trouble. And so it's kind of like, I think one key one that is hard to maintain and track is um, it's like timing of payment and late payments. And so what you want to do is make sure in a business context, you want to make sure you have reliable customers. Sometimes you may have to fire your customer because that customer is just actually a bad customer for you. They are late all the time. They promise, 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 and nothing comes. But now you're the one struggling and you don't have money to um, pay your staff. So some of it is one, being proactive in selecting the right customers that will be able to ensure that you get your money, you get it on time and in full. And B, if you have regular issues, maybe having the courage to fire some customers.
Okay. So how do you recommend building discipline to stick to a cash budget?
I think it's similar to I think first is doing it. I think when you just build one, um, it's the first start. The second, it's always about accountability. And accountability tends to be like you put 1 hour in your calendar every Friday and you say, I'm going to review it. If you want, you get other people involved. Maybe if you're in a small business, maybe whoever is in charge of finance, you say, we're going to meet every Friday, 9 a.m. to 10 a.m., and we're going to review the budget. It could be once a month, depending on your size of your business. So I think regular cadence and review is really the way to have to get discipline on kind of your cash budget.
Okay. So Obina, you can unmute your mic and ask your question so we can wrap it up. We can wrap up the Q&A because we didn't really understand your question. So you can unmute your mic and ask your question, Obina Duru. Yeah, you're raising your hands up. You can ask your question.
Please feel free to unmute.
If there's any other questions we have before we wrap up the session, you can unmute your mic and ask your question.
Hello?
Okay.
Forgive me, my mouth is swollen, forgive me. But see, my late father taught me how to invest in shares, yeah. Well, how do you know, right? in this country, you can never know when these are going to grow and these are going to drop. You never know when you're going to, there's no, like I said, ethics. I call ethics because of the skill. Ethics is skill that's used in this country for different kind of rates, you know. So I'm asking, how do you know when to invest in? It's about return for me. Like you said, money is important, but what's more important than money is more money. So I like what I can invest, my money gets back to me. Well, how do you trust where to go, where to invest? What vices do you look for when you're investing in shares, in land, property, in companies, what vices do you look for to invest, to get your money back? Assure like you sure they're gonna get your money back more.
Well, I tried to follow that, but I'm not sure if I hear. But if I understood you correctly, it's kind of like what should you invest in to ensure that you get your money and you get your returns? Did I understand you correctly?
What do you look out for to invest?
Yeah. Um, I think what you can look out for when you're looking to invest, um, it's maybe like how predictable or stable is the income you're going to generate from your investment. Um, so let's say if I use more of a real life example, you're investing in a house, um, and you need to buy it, and the way you want to get returns on your investment is maybe one, depending on your location, but maybe one is you want the house value to increase. And maybe second is the rent you get from investing in a house. Um, the decision as to whether to go ahead would be, okay, did I invest in the right location? Um, the right location could be like, okay, house prices has been increasing in this place, for years. So I think this is the right location. Businesses are coming in. Then you may look at, can I easily get tenants to fill my house? Um, then maybe it's like, yes, it's near a school, so people are always rent it, or families always come here, so it's very easy to rent it out. So I think one of the key aspects to understanding your investment can be location. Location can be a key aspect. Um, to understand maybe how stable your investment is going to be. It's the same even in a business. You want to build a new factory. It's kind of like, okay, should I build this in this location? Because I can easily employ the right people to help run the business. Maybe like the cost, it's a stable cost. Like, the cost is not going to I'm not going to blink and the cost is going to increase. So I'll say like location helps you kind of also analyze like stability of your investment. Um, Type of investments you do is also something to think about. Um, I think you said FX. If you maybe invest in those kind of things and you realize, and it's always volatile, then that's a risk you choose to take. And so you should already bear in mind that there's a risk that you are not going to get your returns. Maybe if you're maybe investing in something very volatile. Um, then there's the other things like, stocks and shares. So it's kind of like there are some that are known to be stable. So let's say you invest in US stocks, and you more invest in the index. You don't invest in individual stocks because who knows what, nobody can predict the future of a company. And it's high risk, high reward if you invest in maybe one single stock. Say you are very excited about Google, so you invest in Google, tomorrow your stock plummets. Versus, let's say you invest in 500 companies, which is the S&P 500. You invest in Google, Apple, Meta, like all in the index. So if one goes down, the other one can go up and averages it out. And so you invest more in an index versus in individual stocks. So also the type of investment can also determine how well you get your returns. So yeah, so I think there's maybe a couple of example, like location and kind of types of investment.
Okay, so we'll be taking, okay, maybe we'll just take two more questions and then we'll wrap it up. I have a question here from, okay, Chukwemeka. What are some practical strategies for creating a realistic and actionable budget, especially for for small teams and individual projects?
I think when creating a budget, a lot of times is if you can, okay, using historical data can be a good way. So you look at the last like 6 months. Let's say you're trying to forecast revenue, you look at the last 6 months, and then you try your best to also put today's current hat on as well. So let's say in the last 6 months, you generated 1 million, but that's because you did not have the machine that you needed to produce more goods. But now you've purchased the machine and it's come, and then you may adjust it and say, okay, I did 1 million on one machine. I have two machines now. So you're putting on the current hat and you're like, okay, I think I can achieve 2 million because the customer is wanting. So a lot of it can be based on like historical data, but putting on also a current hat on. Sometimes it can be based on expert advice. So let's say it's something you've never done before. You can get like maybe hire maybe an expert who has maybe done it before, to say, okay, can you give us some good rule of thumb on how much, like, let's say you're trying to hire, it's the first time you've ever hired a sales director. It's like, okay, you may speak to people to get a sense of how much you should pay. You can do some market research to understand what the budget should be. If it's maybe individual projects, you can look at, have we done that project in the past? Or you can say, okay, can an expert help me get a better sense of what this should cost? So I think a lot of it is historical data. And if you don't have that, a lot of it can be like expert advice. It's always about kind of seeking help as much as possible. And if you can also, sometimes you can, maybe some people can also, if you have like several departments, you can get input from several people, estimates from several people, and you can look at the range of estimates and then be able to say, okay, which one is potentially realistic? Some people may do an average, some people may just review it and then and then maybe pick the one they think is most realistic. So I think it can depend as well.
Okay, thank you very much. One last question before we wrap it up. Does anyone else have a question? Taking one more question before we call it a day. So, is there any other question? Okay. So, in the absence of no other question, I would want to say a big thank you to you, Chigozie. It was an impactful and a valuable session here. I personally learned a lot about budgeting, cash flow, and finance in general. I'm sure a lot of people here also, you impacted a lot to their financial, everything. So thank you very much. And hopefully you'll be joining us soon for another great session. And, we're really, really, really grateful for today. It was really good. And yeah, thank you. So I'll be talking briefly about Brickhills Consulting, what we do, and our accredited courses. So we have courses ranging from management to leadership courses. We have project management courses. We have the Kiddies Corner where you have courses for kids from age 3 to 7 and from age 8 to 12. We also have engineering courses and AI courses, So the process, we have three modes of learning. We have the in-person learning where you can take your courses in person, and we have the virtual learning where you have your instructor take you on the course, and we also have the video learning where you learn at your own pace. So all of these learnings, you get your British accredited certificate at the end. And then we have three stages of learning. We have for the beginner stage, we have for the level stage, and the master class as well. So the master class is the final stage where you have like a thorough process, and you also get your certification through these three stages as well. Brickhills Consulting, we are here to serve you, and we cover courses in all areas from marketing, even the courses that you're not familiar with. That's why we take you from the beginners level, take you through all the process, and for you to understand, and at the same time, you get certified. We can be found, our website is www.brickshillonline.com, where you can sign up today, go through the courses, and, take note of any course. You can also send us an email or a message if you have any questions whatsoever. So this class will be uploaded on our YouTube channel. Also on our YouTube channel, you can also go through our other courses that we have done in the past, and this will be uploaded in 2 days. So you can go through the entire video in case you missed any area from the beginning to the end of today's session. And we have these webinars every month. You just have to sign up with us and, follow through to different courses. We take different courses every month, depending on what, the demand is for the course. And yeah, that's it. So we would see you next month, at the end of next month. Do well to go through our website and sign up. And you can always send us an email or any message on our social media as well. Thank you very much for joining us today. Bye.
Thank you. Goodbye.
Yeah, bye. Yeah.